Can we talk a little bit about how mortgage rates are actually set? So I know that most people think that when the Bank of Canada drops rates, immediately their their mortgage rate decreases. But it's a lot more complex than that. Can you unpack it a bit for our listeners?
Yeah. So Bank of Canada cutting rates, they're technically cutting what's called the overnight lending rate, which is how banks base their prime rate off of. And anybody that has a variable mortgage or variable interest product would see that their rate will change. So a secured mortgage, that's a variable rate, a line of credit, unsecured or secured, those are types of variable products, for instance. And so if there's a cut of 0.25%, then immediately if you're in a variable mortgage or have a line of credit, your interest rate would be reduced on that debt. This is where the misconception comes in. People think, oh, I have an approval for a fixed rate mortgage. The Bank of Canada cut 0.25%, so I get a discount to my interest rate too, right? And the answer is no. So what does happen is, for instance, last week, when all of a sudden the jobs data got a lot weaker, the bond market does shift. And so the bond market is what impacts the fixed rates. But the bond market moves completely independently of what the Bank of Canada is doing, because it predicts what the Bank of Canada is going to do in almost real time. So as soon as the job data comes out, you can see a massive decrease to the bond market, and it went down about 0.1% in a matter of like an hour, which is a very quick movement, and that's very common. And the reason for that is the bond market is a forward-looking market. It predicts what is going to happen. So by the time that the Bank of Canada makes this decision, the bond market pretty much knows what's going to happen before it even happens. And so they've already built in those estimations, which impacts fixed rates leading up to the announcement, not the day of the announcement.
Last time we had you on the show, Kyle, I feel like we talked a little bit about the disconnect between the overnight rate and the bond market because of all that wacky stuff after the tariffs in the bond market. Is that disconnect still there, or is the bond market starting to act kind of more traditionally or more the way you'd expect it to act? Is it coming more in line with rates, the Bank of Canada rate?
So here's the interesting thing. Let's say that you wanted to get a 5-year fixed rate mortgage, then you would be more likely to watch what the 5-year bond yield is doing, because that's the product that would be most likely matched to what term you're looking for. Now, what happens is, if, for instance, the Bank of Canada looks like it's going to cut aggressively short term, but then will have to increase rates in 12 months or 24 months very quickly, then the bond market might actually have no impact at all, even if they think, oh, now the Bank of Canada is going to cut. Because the 5-year money is basically a projection of what's going to happen for 5 whole years. Now, what you do see, however, is if there's a higher likelihood of a cut to the Bank of Canada, and they might increase in a year or two, you'll see that the 1-year bonds and the 2-year bonds will fall more substantially than the longer terms will. So it's actually a matter of what they think will happen over a 5-year period, because that's how long the bond is set for. Now, what's happening is the weak jobs data is showing, okay, well, we think that the Bank of Canada might cut a little bit more aggressively and maybe is less likely to increase rates because of tariffs in the future in a couple of years as much as initially predicted. And so it has had a dampening effect, a positive effect on the bond market. But sometimes the Bank of Canada will cut and there's literally no change to the bond market at all. In fact, sometimes the bond market will even increase that day, because that was already assumed and caked into the marketplace.
So at this point, I guess, you kind of touched on this, but I'm thinking specifically, I guess, variable versus fixed, but also term for fixed. So, I glanced at, I think I mentioned this to everybody I talked to, that my mortgage is coming up, but I can click on, the app and it will give me, here's the offer coming up in the next couple months. The 3-year seems like a significantly better rate to me than the 5-year. Can you talk a little bit about those 3 options and kind of how you're navigating that right now?
Yep. Yeah, so the tricky thing is, obviously nobody knows where rates are going to be in the future. But if you look at what the expectation is and just use that data to help you make an educated decision, then the math really is how much different is the interest rate for the 3-year versus the 5-year short term? And then where are rates expected to be when you renew in 3 years' time? And so if right now, do you remember what the spread was between the rates that you got offered?
I think it was like just over 4 and maybe 4.4 or something like that. That sounds too big of a spread?
In some cases, it can be a bigger spread than others. Yeah.
It might have been, maybe it was like 20 basis points, let's say. Does that seem reasonable?
20 is pretty typical. Sometimes I have seen it where it's 30 or even 40, but usually 20 is...
It might have been 20. It might have been 20.
Yeah. So let's go through the math. Now, this is a simplified version of it because technically you get a lower interest rate for the first 3 years. You pay a little bit more principal, a little less interest in the front half of it. So that's not quite exactly this calculation. But the easy math is, let's say there's a difference of 0.2% for the first 3 years. That means that in aggregate over the first 3 years, you would have saved 0.6% in the first 3 years of the 5-year time frame that we're looking at. What that means then is that when you renew the mortgage at year 3, if the rates are 0.3% higher in 3 years' time, then you would pay 0.3% for 2 more years, which is 0.6% in the back last 2 years of the 5-year term. So you would have saved 0.6% in aggregate the first 3 years and then paid 0.6% in the last 2 years of a 5-year term. So that's a really easy math on it. Currently, and I think these trends are changing now, and I haven't seen new data because this is pretty recent stuff, but the data was showing that they were expecting rates to be about 0.1 to 0.2% higher per year over the next 5 years. So over a 3-year span, expectation was that fixed rates would be 0.5% higher, which means that you would be paying 1% more in the last 2 years and saving 0.6% in the first 3 years. So you'd actually be better taking the 5 versus the 3 if the spread was only at 0.2% savings.
So does that, just so I understand, if you're thinking variable 3-year or 5-year, if that forecast is accurate, 5-year fixed is the product
in general. But if the gap is 0.3%, well, okay, now I'm going to save 0.9% and maybe pay 1% more in the back half. That's a bit more break even. And for some people, it's like, well, bird in hand versus potentially expecting rates to go up, which I'm still not personally totally sold on rates being higher in the future. Here's the tough part about predicting rates is if you look historically at predictions and interest rates, 90% of the time, it's a slow increase to interest rates because they're always projecting, well, with this market growth and this and all these different economic factors, usually rates are predicted to go up slightly. But what causes interest rates to decrease and decrease significantly are things like 9/11, Brexit, COVID, the subprime crisis, things that generally aren't predicted. And these all have a major push down on interest rates, and you can't predict those. If you assume, okay, well, rates are probably going to tick up slowly, but what about something in the future that nobody knows is going to happen that's going to then to have the opposite impact and push rates down? And that's where if you start to get more to closer to break even, it makes it harder. And so it really depends on the situation. We have a lender right now that has a very quick close. Like it's only a 30-day rate hold. You have to fund by the end of October, have to submit the deal by end of September. And that's assuming they don't pull it off the shelves. But they're offering 3.99 on a 3-year fixed rate, whereas they're offering rates that are about 0.3% higher on a 5-year fixed rate. At that point, for a lot of clients, a lot of them are saying, you know what, I'd rather take the 3-year, especially with the recent news that might not be as inflationary moving forward and might be more inclined to see more cuts from the Bank of Canada. So the pendulum swings all the time.